The first mistake is overpaying in fees, and this one can cost you hundreds of thousands, if not millions of dollars in wasted money. If you didn't know that your 401k had a fee, I hate to be the one to break it to you, but you should check this out. When you invest your money into 401k, whether it's traditional or Roth, and you put your money into an index fund, a mutual fund, or an ETF, that fund has a fee. That fee is called an expense ratio, and that fee is going to be charged on every dollar that you invest and every dollar of profit that you make for every year that your money is invested in the 401k, whether you're making money, losing money, or staying even. But here's the part that a lot of people don't understand. Not all funds are made the same. Some funds are going to have significantly higher fees, while others are going to have lower fees. For example, mutual funds are generally actively managed, meaning there is an actual human being that's managing that fund. They're making trades in and out of that fund to try to get you the best returns. Well, because you're paying for that actual money manager to do the work, you're going to have higher fees, and you want to factor that in there. Compare that to an index fund, which is known as generally a low-cost fund. These are generally passively managed. So you're not paying for a human being to actually manage and make trades out of that fund. You're paying for a computer algorithm to manage that fund for you and to kick out companies that don't meet the requirements of that fund. And it's much more passive because you have to pay per person, so your fees are generally a whole lot lower. And the mistake that so many people make here is they don't realize the compound effect of their fees. Take a look. If you were investing $800 a month, and now because you put your money into a mutual fund, you're hoping to beat the market, so you're averaging, let's call it 11% a year in growth on your money, and then you have to pay 1% in fees, which is actually not that high in the grand scheme of 401k fees, especially if you look at older people's accounts. A 1% fee is very average. A 1% fee, and you do this for 30 years. Well, after the 30 years, your $800 a month is going to grow to $1.7 million. Not bad. But the part that a lot of people forget is that over the course of those years, the small little 1% fee is also compounding, which means you also, over the course of those 3 decades, paid $400,000 in fees to your money manager. Again, not necessarily a bad thing because you got a good return, but what if there was a way for you to keep some more of that money for yourself? So take a look at this. You do the same thing. You're investing the same $800 a month, but now instead of investing in a mutual fund that's actively managed, you're investing into a passively managed fund that's giving you exposure to the broad market, and the markets have grown by around 10.5% a year. Now, because you're doing a index fund that's passively managed, your fees are going to be less. So now instead of paying 1% in fees, you're paying 0.1% in fees. Less fees, but also less growth. You do it for the same 30 years. Well, now, instead of having $1.7 million, you're going to have about $1.9 million, an extra $200,000 in your pocket, and you're going to be paying around $30,000 in fees in this instance. Now, you're able to walk away with an extra couple $100,000 by making a small little tweak. You're getting less returns, but because your fees are significantly less, it's more profitable for you to do this than this. Now, again, investing is risky. Nobody knows what's going to happen in the future, but it's very important for you to pay attention to these fees because these fees are compounding, and if you don't understand the real cost of these fees, you could be overpaying on a fund that's not giving you the returns that you should be hoping for. Mistake number 2 is you don't adjust your contribution after switching jobs. 55% of job switchers reduced their 401k nest egg by $300,000 over their working lives by failing to adjust their savings rate to their new higher salary. So more than half of America is doing this. Again, the numbers are hypothetical, but you'll get the idea. You're working job 1 making $70,000 a year, and you're investing $7,000 a year. Great. Now you find a new job at company 2 with a higher salary. So now you go from making $70,000 a year to $80,000 a year. You open up a 401k, and now you're going to invest, well, you're going to invest the same $7,000 a year, which means you're making more money, but you're investing nothing more. Those small incremental adjustments to how much you invest can add up to big dollars on the back end. I mean, if you're investing $800 a month at the 10.5% a year, you're just getting the market returns with a 0.1% fee. Over 30 years, you're going to have $1.9 million. But if instead of investing $800 a month, you could now invest, let's call it $1,200 a month, and you do the exact same thing for those 30 years, well, instead of having $1.9 million, now in this case, you would have $2.35 million. So we're talking about an extra $450,000 by just investing an additional $400 more a month. Now again, $400 more a month can seem like more money, but as you start to earn more money, Well, you can keep investing slightly more money. That way you have more money working to compound and grow. That way you can build more wealth by letting more money work for you. Mistake number 3 is you put your money into a bad fund. Let me ask you a pretty simple question. Would you want to put your money into a fund that's been underperforming the market and charging you above average fees? What you talking about, Jaspreet? My 401k doesn't have funds like that. Well, you might want to check again. More than 99% of 401k funds offer at least one overpriced and underperforming fund to plan participants over a period of 3, 5, and 10 years. I'm not going to hammer this point home too hard because I think it's pretty self-explanatory, but if the funds that you're investing in have been underperforming the market, charging you above average fees, well, you have to have a strong case to want to invest in that. Number 4 is forgetting your 401k, and I cannot believe I have to talk about this, but take a look at this data. As of 2025, estimates suggest that there are over 29 million forgotten or left behind 401k accounts in the United States, totaling around $1.7 trillion in assets, according to the Employee Benefit Research Institute. You're working a job, you open up a 401k and invest a little bit of money, but then you realize you hate this job. So now you find a new company, open up a new 401k and start investing, and you get so excited about the new company that you forget about the old 401k, but it was just a little bit of money, just a few $1,000s, not anything crazy, so you just let it go. Well, those small sums of money can add up to big dollars over time. If you were to invest $3,000 today and you never invested another penny again, this is money you forgot in your 401k, and that money just grew by the market average of just 10% a year, and you let this money sit there and compound for 45 years. Again, you never invested another penny because you forgot about this account. Well, over these 45 years, this small $3,000 is going to grow to over $200,000 of lost money because you forgot that this account even existed. So don't forget about the small money, take it with you. Number 5, do not forget about your employer match. Some companies who offer a 401k also offer an employer match. And what that means is they will give you money to put into 401k matched up to a certain percentage. So if you make $50,000 a year and your company offers a 3% match, that means if you were to invest $1,500 into 401k, your company would give you an additional $1,500 because that's 3% of your income. But if you were to invest just $1,000, your company would only give you another $1,000. If you invested $2,000, well, the company will only give you $1,500 because they'll match it up to 3% of your income. So if you're going to use a 401k and your company is offering a match, well, take advantage of that match because that's money that they're offering you to invest your money as an incentive. So if you're going to use the 401k, might as well use it to its max. Last but not least is number 6, stopping at your 401k. Now this is going to sound very weird for me to say at the end of a video about 401ks, but I personally do not use a 401k. I personally do not use an IRA. I personally do not use any government retirement vehicle because it doesn't fit within my portfolio. I know that I can get better tax advantages outside of a 401k, but personal finance is personal. I'm not here to tell you what to do. I want you to understand the best way to maximize your investments by understanding what the options are and finding the best options out there. The reality is, for many people, your 401k is not going to be enough for you to retire. Investing 3% of your income into your 401k is not going to be enough for you to have the dream retirement. And then having that with Social Security still is not enough, which means you are going to have to invest your money yourself. And that means you got to figure out other ways that you can invest your money outside of a 401k as well. And as you start to do that, as you start to become more involved with your investments, now you can decide, do you want to keep using a 401k? Do you have better options outside of a 401k? Do you have better growth vehicles outside of a 401k? Do you have better tax advantages outside of a 401k? And as you start to become more involved, you can make that decision for yourself instead of just blindly following a random guy on YouTube. But the mistake that so many people make is they assume, I got my 401k, I own a house, I am ready to retire. This is one of the biggest lies that we've been sold, and it's why we're facing the biggest retirement crisis that we've ever seen in the history of the United States. It's not enough. It's a great place to start, but you got to do more as well, which means maybe open up your own stock brokerage account and start investing your money into the markets. Maybe go out and start investing in rental properties. Maybe go out and start investing in startups. Maybe go out and start investing in your own business idea. Maybe go out and start making some more speculative investments into cryptocurrency or something else. Again, Personal finance is personal. You got to find what the options are, but you have to invest your money outside of your 401k as well. This is one of the reasons why I put together that investing masterclass, where I'll walk you through how you can learn how to invest and find investment opportunities. Again, I have that link for you down in the description. But the whole idea is you cannot just rely solely on your 401k and Social Security and hope to have enough money to live a financially free retirement. If you really want to be free and get there sooner rather than later, you need to be investing more aggressively instead of just the small percentage of income that's going into your 401k. You have to actually be investing more money. That way you can build more wealth and not have to rely on your kids or something else to take care of you when it comes time for you to retire. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.